Once, Switzerland printed so much money that people around the world started begging for more of it. Not joking. In most countries, printing huge amounts of money ends the same way. Inflation, currency collapse, public panic. You print too much, prices explode. That's the rule. Zimbabwe learned it. Venezuela learned it. Even the United States saw inflation spike after trillions were pumped into the economy during the pandemic. But Switzerland? Switzerland printed billions. Its central bank balance sheet became one of the largest on Earth compared to the size of its economy. And somehow, the Swiss franc became even stronger. Which raises a deeply uncomfortable question. What if printing money is not actually the dangerous part? What if the real question is, who is printing it, and why does the world trust them? Because Switzerland is running one of the strangest financial systems in modern history. A system where a small mountain country of under 9 million people became so financially trusted that global investors accidentally created a problem most nations would kill to have: too much demand for their money. And that sounds amazing, until it starts hurting your own economy. Here's the weird part. Switzerland does not want its currency to become too strong. Most countries dream of having a powerful currency. Politicians brag about it. News anchors celebrate it. It sounds like national success. But Switzerland learned something most people never hear. A currency can become so strong, it starts suffocating the economy underneath it. Imagine you run a Swiss watch company, or a pharmaceutical company, or a precision engineering business. You sell products globally, mostly to the United States, Britain, Canada, Australia, and Europe. Now imagine the Swiss franc suddenly becomes extremely valuable. Your products instantly become more expensive for foreign buyers. That beautiful Swiss watch that cost $5,000 now costs $6,500. Nothing changed about the watch. The currency changed. Suddenly, exports slow down. Factories feel pressure. Tourism becomes painfully expensive. Even hotel coffee starts looking like a financial crime. And this kept happening because whenever the world becomes nervous, money floods into Switzerland. Financial crisis? Money enters Switzerland. War? Money enters Switzerland. Bank panic? Money enters Switzerland. Global uncertainty turns Switzerland into a giant financial bunker. Investors trust Swiss banks, Swiss institutions, Swiss neutrality, Swiss stability. So during chaos, global capital runs there almost automatically, which sounds flattering until your currency keeps rising higher and higher. By the late 2000s, this became a serious problem. Then came the 2008 financial crisis. The United States banking system nearly collapsed. Europe entered debt crises. Investors panicked, and huge amounts of money rushed into Swiss francs. The currency surged. Switzerland's central bank, the Swiss National Bank, realized something alarming. If this continued, Swiss exports could become uncompetitive. Parts of the economy could slow badly. Deflation could start spreading. And deflation sounds harmless until you realize it can freeze an economy. People delay spending. Businesses delay investment. Debt becomes harder to repay. Growth slows. So the Swiss National Bank decided to fight back. And this is where things become bizarre. Instead of protecting the franc, they started weakening it on purpose. They printed new Swiss francs digitally, then used that money to buy foreign assets, mostly euros, foreign bonds, and eventually even stocks. Yes, the Swiss Central Bank became one of the largest institutional investors on Earth. At one point, it owned massive positions in American companies like Apple and Microsoft through its foreign reserve portfolio. A Swiss central bank in the Alps quietly became deeply connected to Wall Street. That's not the image most people have of Switzerland. But the logic was simple. If global investors kept buying Swiss francs, the Swiss National Bank would create more francs and push money outward into foreign assets, basically flooding the market with additional currency supply.
In theory, that should weaken the franc. And under normal circumstances, aggressive money printing should trigger inflation. But Switzerland kept escaping the usual consequences. Why? Because money works differently when the world treats your currency like a safe haven. This is the hidden mechanism most people miss. A currency is not just paper, it's trust. And Switzerland accumulated enormous amounts of it over decades. Low political instability, strong institutions, conservative banking culture, relatively controlled debt levels, a long reputation for financial caution. So even while Switzerland expanded its money supply, global demand for the franc remained extremely high. The world kept absorbing the new currency. That demand acted like a pressure release valve. Imagine pouring water into a bucket with holes at the bottom. The water keeps escaping before the bucket overflows. That's basically what happened. New francs entered the system, but global investors kept grabbing them. Meanwhile, much of the created money flowed into foreign investments instead of directly overheating local consumer spending. And this created one of the strangest ironies in finance. Switzerland was printing money, partly because investors trusted Switzerland too much. But there's another uncomfortable layer to this story. The system only works so long as trust survives. That's the fragile part. Because modern money is not backed by gold anymore. Not really. They're backed by confidence. Confidence that institutions remain stable. Confidence that inflation stays controlled. Confidence that governments behave rationally. And confidence can disappear surprisingly fast. Even Switzerland has faced pressure. Its massive balance sheet became controversial. Its interventions distorted markets. Negative interest rates plenished savers for years. Swiss real estate prices climbed, and critics started asking whether the country had quietly become dependent on financial engineering. Then, in 2023, even Credit Suisse, one of Switzerland's most famous banks, collapsed into emergency rescue talks. For a moment, the image of perfect Swiss stability cracked. Not shattered, but cracked. And that's what makes this entire story so fascinating. Because Switzerland did not break the laws of economics. It simply discovered something deeper about them. Money printing is dangerous when trust disappears faster than money is created. But when the world desperately wants your currency, you can bend rules other countries cannot, at least for a while. That leaves one final question hanging over the global financial system. If modern money is built mostly on trust, what happens when the countries printing the most money slowly stop being trusted at all?